Welcome to It's the Economy. The big number we await today at 4 p.m. is the second quarter GDP number. Our CNBC TV18 poll sees Q2 GDP at 6.5%, and that's the lowest in 6 quarters. This 6.5% compares with 6.7% in just the previous Q1 and 8.1% year ago in Q2. The Reserve Bank itself has forecast 6.8% growth for Q2, the quarter that ended on September 30th, but that is down from its earlier forecast of 7%. Now, our poll also sees the GVA, gross value added, at 6.5%, same as GDP, versus 6.8% Q1 and 7.7% year ago. The GVA actually is a better measure of the economy. GVA, you just have to add taxes, subtract subsidies to get to the GDP. Now, as per our poll, GDP is dragged down partly by poor showing of manufacturing and electricity. However, services are expected to have done well at 8.2%. Let's see. Looking at GDP from the expenditure side, the fear is that government Capex, or gross fixed capital formation as it's called, which was doing well till about a quarter ago, may have slumped in Q2. Our poll also shows that some economists, including the Reserve Bank, see a very smart rebound in the second half. That's the CNBC TV18 poll expecting 6.8 to 7% growth in the second half, Q3 and Q4. The Reserve Bank itself expecting 7.4, but not all people in the poll are agreeable to even 6.8 to 7%. So that 7% plus growth, which the Reserve Bank is forecasting, doesn't have too many supporters now. So have we given up the 7% growth pace altogether, which we had over the last 3 years? That we will know only in May of 2025, next May. But first, let's concentrate on the number that's coming later today, the second quarter GDP. We are joined by the chief India economist and economist for ASEAN at HSBC, Pranjul Bhandari, who's joined us in our studio. Pranjul, first up, I wanted to ask your estimate. Do you think we will even make it to 6.5? Because I had quite a few people saying 6.3, 6.4 for Q2.
Right. So we are at the 6.5% ballpark. That's our forecast. And fingers crossed, we'll know in a few hours. But I think the details are important. I think what we've seen really is urban consumption slow in this quarter. A bit of it has also come from the fact that, we don't have very strong consumer loans anymore. Some of the salary and wage growth at high-end sectors has softened a little bit. And rural consumption hasn't yet picked up. We're all hoping it picks up, but it hasn't yet picked up. And then there was government expenditure, at least in the first 2 months of the quarter. It was quite weak. We were coming out of the elections. It only picked up in the September month, but we haven't really seen all of its growth impact yet. So putting all of it together, the September quarter will not look very good.
Okay. So what about the rebound? I mean, okay, that is done and dusted. We saw the Nifty earnings also was just about 2%. The performance of companies was also not, a little underwhelming. What about second half? I have a wide range with some people expecting lower than 6.5 also for the second half. And of course, the Reserve Bank standing at 7.4.
Right. I'm a little more constructive on the second half. And I think for me, the big change could be rural India. Already, I'm seeing agriculture data picking up. My sense is we've come from a very bad agriculture year. The money farmers made in the summer crop, Kharif crop, they didn't use it for spending. They used it to build back savings. And I can actually see it in the Jan Dhan cash balances that, rural Indians have. But I think the money they make from the winter crop, which we see in February, March, I think that will be spent more on consumption. And then we can see an uptick, in, consumer staples, two-wheelers, the kind of things rural Indians buy. Also on the side, we have government which has given out a lot more money for Capex over the last couple of weeks. Once that starts and that construction boom begins, we'll see remittances go back from urban to rural India, something that had stopped in the last couple of quarters. So my sense is, and I'm looking for a rural rebound, not immediately, but around February, March.
Oh, okay, that far. So Q3 is still a bit of a question mark. The other question marks which other economists are putting is that, for instance, I think yesterday India Ratings put out that report that government can't spend all its money on Capex. And we had, I think, the DEA secretary admitting that they may not reach the target. The problem could be that, in the last 3 months, there is only that much that can be pushed because the government becomes busy with budget, etc. The other reason is that the absorptive capacity of the economy is only that much. You can't push, 11.2 lakh crore that you think should be put in, that many engineers, that many ability to draw up plans and the ability of the economy to absorb. Are you worried that Capex also may not grow so much?
So look, I hear what you're saying and I agree with you. We lost 4 or 5 months because we were in the election process in which a lot of new Capex, files getting approved doesn't really happen. So we've lost that. But I'm going to only focus on the upcoming months, and I think that things can look better than it was in the past, because I think the first half of the year, the government focused on current expenditure, subsidies, revenue expenditure. Second half, that money is going to be put more on Capex, and I'm seeing that in the data I track. Also, some of the data we track on NHAI projects coming up, I think they all show that things will look good. But for the year as a whole, Latha, I don't think we are a 7.5% plus economy, which is what we had gotten used to in the last couple of years. I think we are more like a 6.5 to 7, which is a percentage point lower than 7.5 to 8. And I think this is the realization which all of us, the equity markets, corporates, are going through. Maybe 7.5, 8 came from low base. Some new sectors like GCCs coming off a very low base, growing very fast, but you can't sustain that. I think we'll now be more a 6.5 to 7% economy in the next few years, which in itself is very good.
Okay. No, I'm throwing, kind of the devil's advocate questions at you. I think the Reserve Bank got it right last year, much more than the street. They were positive about growth and it turned out. So maybe they have a trick or two, which we don't know. I'm just looking at the doubts the market has, and one of them is cost of capital. See, the Reserve Bank may not have that much scope to cut. You tell me, what are your expectations? And secondly, even liquidity. They were generous with liquidity earlier this year, but now, since they have forced to sell dollars, they are obviously draining liquidity. There is a dearth. I mean, there is a chance that liquidity will not be plentiful. Equally, for both reasons, do you think credit offtake may not be gangbusters?
Well, look, I think easing monetary policy, RBI is looking at two things. One is inflation, and the other is what happens to the dollar, like the FX markets generally. The good news is I think that inflation is coming off. Even in the last week, we finally started seeing vegetable prices come down. My sense is inflation will fall from 6.2 in the last month to 5.5 in November, which is a pretty substantial fall and could fall even more in the next couple of months. So inflation is not my number one worry. What I'm really looking at is what happens to the overall dollar index. If at some point we realize that it has overreacted and it stabilizes or weakens, I think the RBI will get its chance both to cut the repo rate and also to rebuild its FX reserves, which in a way is how you can infuse domestic rupee liquidity back in the system, and things will be fine. Except that I don't see this dollar retracement right away. So I think the December policy meeting, the RBI will not be able to do very much. And our best hope is that something comes up in February in terms of monetary policy easing.
Okay, you expect a rate cut in Feb?
That is our forecast for now, but a lot depends on the dollar environment, and in a way, I think it's a toss-up between February and April. But our call is for a Feb right now.
Okay. Now, what's the sense that since now you handle ASEAN and a much larger part of the world, what's your sense about global economic growth in calendar 2025? There will be this US exceptionalism, there will be this threat of tariffs. And there is generally a feeling that business investments fall at a time when there is policy churn. It happened in 2018 when Trump raised tariffs and business confidence or business investments fell. So do you think global will be a headwind for us and not a help?
Well, look at an environment of rising tariffs and policy uncertainty, things like FDI flows, all of them slow. So yes, from that perspective, we need to brace for lower growth. But I'm going to take go a level deeper. There can be winners and losers, right? And I think India has its task cut out. My sense is that in the last decade, we haven't really been able to gain from supply manufacturing chains getting rejigged in a major way, particularly for mid-tech manufacturing, like textiles, clothing, footwear. A lot of the business actually has gone to, like, say, Vietnam or to Mexico. But over the next couple of years, I think India has been given a second chance to actually grow its manufacturing base, attract some of this mid-tech FDI, and which, by the way, is also like jobs accretive, you know, and this is our chance. So I'm going to be positive that yes, you know, the environment is not great, but within that, if India plays its cards correctly, it could actually come out on the right side.
Okay, so you have a FY26 GDP number?
My midterm GDP growth number is 6.5%.
Okay.
Which I think is a good number in the current global environment.
I had at least half a dozen economists telling me that. They have between 6.3 and 6.5 for next year, which is far slower than what we have got used to in India in the past 4 years. But they keep saying that in this environment, 6.5 is a damn good number if we can make it. Just a final word on, you know, inflation itself. Not all economists are that confident. There are a couple of people who are, you know, forecasting 6% even for November. And there is a fear that, you know, going forward as well, we may not be able to see that much of a fall because of stickiness in food prices. But do you think we are at 4% inflation for the coming year, FY26?
Look, I worry about a lot of things, but inflation is right now not my number one. And I'll tell you why. I think with, you know, excess capacity, you know, Chinese excess capacity, with a fairly hawkish central bank, which is keeping second round inflation expectations quite contained, I think core inflation will remain range bound over the foreseeable future. And then it comes to commodity prices. My sense is if global growth is going to weaken, commodity price will actually fall. And then the third is food prices. Impossible to predict given all the climate change events. But right now, because temperatures have normalized, reservoirs are full, I think the next 4 to 5 months, we can see food prices come off. Oh. So I do think that by March, we will get to inflation, which is less than 5%. Over the medium term, I think we will come at about 4.5%.
Okay. No, if that is a problem, less to worry, so much the better, because that impacts everyone, and it's a big, good, positive takeaway that we don't have to worry about inflation around the 4 handle. What about dollar rupee? Is there an internal HSBC range? Does it go to 85? Does it cross 85? How do the next 6 months look?
Look, our sense is that we will have to brace for a gradually weakening rupee versus the dollar, and we have a call for about 86 over the next 2 to 3 quarters, so gradual depreciation.
Okay, so FY26, let's prepare for, or whatever, calendar 2025, let us prepare for an 86 handle on the currency, but the positive would be inflation. And perhaps growth, with a bit of luck, should make it to 6.5%. Thank you very much, Pranjul Bhandari, for joining us. Just one final question. What is the big number you will watch out for when the GDP numbers come out today? Just help us train our eyes.
You know, I'm going to look at this gap between GDP and GVA, which has bothered us a lot. You know, we've had like a quarter in which GDP is way higher than GVA, then we have GVA way higher than GDP.
What about private final consumption and expenditure, consumption and capital formation? Consumption and investment, is not that a big worry that...
Yeah, so look, the thing is, I would love to look at what's happening to private consumption, because the slowdown that we are seeing, I think it's coming from consumption, right? Rural and urban. The only problem is whatever data will come out today, in a couple of months' time, it's going to be revised. Okay. Because in a way, it's the balancing item when MOSPI comes out with its GDP on the expenditure side. But surely I'm going to take a look at that. And it'll be very interesting to see that, is it very clear that we are more an investment economy than consumption? I do think we need a couple of quarters of consumption being high so that a new round of investment can come on the back of that.
Fair point. I mean, I would watch very closely for that. Of course, it's lagged data. It's data up to September, and we are all hoping that the festival season has improved consumption. Thank you very much, Pranjul Bhandari. We will remember all that you told us to look for when the GDP number comes out today. That's it on this edition of It's the Economy. See you at 4 or 4:30 when we will have the GDP numbers.